often when we do have competing investments, we usually tell the founder themselves that there's a conflict of interest. And very often VCs respect this and say, look, we can't invest in you guys purely because we have invested in your competitor.
Something that it's also important is obviously looking exactly at what stages is the fund you're speaking to investing in and the geography.
The first segment that we usually jump into is what I wish founders knew. So, in your interactions, whether as a friend or a mentor or as, on investment calls over the last few weeks, what is something that you found yourself thinking, gosh, I wish founders knew blank?
Sure, I'll jump in, Andrew. For me, I would say, and it's something I've seen not just over recently, but for a very long time, it's the go-to-market plan and the customer acquisition cost, customer lifetime value. It's really absolutely critical to see if there is a real business opportunity for this particular organization. And if you haven't got customers already, then at least have pilots agreed, or at least do some test marketing to prove that there is a real business opportunity for your product or service and the sort of value you can deliver to those customers and how much they're likely to be prepared to pay for it. So for me, that's absolute critical in any pitch deck I see or business plan I see.
And something else I'd like to add is that differently from the US, something we're seeing a lot in Europe and specifically in Southern Europe, that I wish more founders were aware of is do not be afraid to burn cash or to be gross margin or EBITDA negative if that means that you're growing a lot, because we and see that the rest of the market tends to put much more weight on having a very high revenue growth as opposed to be profitable from the get-go.
Well, it's easier to not be afraid to burn cash if you have investment. But if you haven't gotten it yet, maybe you should be afraid to burn cash because otherwise your company might die very soon. But yeah, that makes sense once you have the cash.
Maybe latching on to Paulo's point there, which I think is very fair, but also it kind of assumes that you know how venture capital works, you know how successful startups can grow under certain circumstances. I think, and also going back to Colin's point, that I think it's really important when we meet many great deep tech founders of all backgrounds, that they really think about why they're sitting there. And also Professor Three's point, and if that's the right fit, right? Like we now so many founders are doing great stuff and maybe are very impact driven, but ultimately for them, venture capital might not be the best funding source, at least for starters, and they never thought about the market size, never thought about making this a big commercially viable business, even an impact business. If you mentioned that, so really think twice about why you're doing this, why you want to sit in front of VCs and take up a lot of your own time and also everybody else's time, and be really clear about why you're in the game, and then educate yourself a bit more about what it means and why VC-backed business is very different from a bootstrap business, and both of them can be tremendously successful. But I guess going back to a little bit more doing your homework and then find the right partners to talk to and then have the best possible conversations.
That can be hard, though. I can say that what I hear from founders a lot is they're not really sure the balance between, like if they're looking up a VC and it says that VC is invested in like competitors, for example, companies in similar industries. Is that a good thing or is it a bad thing? Is it a bad thing because, well, a VC isn't going to invest in me if they've invested in a direct competitor? Or in fact, they might steal information about us. I have to be worried about that. So how do you choose the right VC? Is it based on past investments? Is it just based on, well, if they've invested in similar industry, but not a direct competitor, like just a similar competitor? Like what's the right kind of mix, if you guys understand what I'm trying to get at here?
Yeah, maybe if I can touch upon the comparator angle. So this has happened a lot with our fund in particular. There's a lot of startups who approach us and say, hey, look, we see in your portfolio that you invest in our comparator. And what they don't realize is that we actually have two separate funds. So we have an EIS fund and then we have a Series A fund. Most of the comparators that we have invested in is from the EIS, not the Series A. So often when we do have competing investments, we usually tell the founder themselves that there's a conflict of interest. And very often VCs respect this and say, look, we can't invest in you guys purely because we have invested in your competitor. I think majority of the VCs won't actually invest in multiple different competitor in one space, provided that they have multiple different funds. But obviously this is something that startups themselves don't have knowledge on. But I think one of the best ways to sort of approach this is just looking at the portfolio of a VC and try to see, okay, is this something that would fit us in the sense where do we fit into their portfolio? Can they help us out in this particular industry or in this particular stage of the startup? That's just one easy way to look at it. But obviously, if there is a competing company in their portfolio, very often a VC would turn any other investments down.
Yeah, I fully agree with Tri, and that has happened to us a little bit. And in general, it's pretty hard for us to invest if we have a competing company or a portfolio already. Something that it's also important is obviously looking exactly at what stages is the fund you're speaking to investing in, and the geography, because having someone that speaks your language or that can help expand to whatever country you want to move in, it's also very highly valued and pretty important.
And Andrew, maybe going back to your previous point, completely appreciate that raising capital can be daunting and new to many. And I think what you said is absolutely true, that you should look at past investments of any investor you're talking to, including did they invest in any competitor, and I don't know of hardly any VC who would invest in competitors willingly, because you cannot just back two different teams in the same game, right? But yeah, looking at the past investments and how they operated is incredibly helpful. And once you go a little bit deeper with any VC, I think it's only fair to ask also for introductions to the portfolio, or do it yourself. Call up some founders in that VC's portfolio and ask, hey, how are you liking it? Drop them an email, ask them for a chat. I think that's not unheard of, and probably shows that you're really interested to find out who you're talking to.